Hi everybody, welcome back. Today we are going to review chapter 14 in the OpenStax textbook. This chapter looks at money and banking. And this is a great way to prepare for understanding monetary policy, because really what's key to monetary policy is understanding fractional reserve banking. And so in this chapter, we're going to go through, we're going to talk about the functions of money, this idea of bartering versus trading goods and services with each other versus buying things with money. We're going to talk about how we measure money, talking about M1 and M2. We'll talk about measuring money in terms of liquidity, which doesn't mean how liquid it is. It means how easily can we get cash to buy goods and services. And then we'll talk about the role of banks, how banks function in our society, why they're important, why they're key to economic growth. Really, they really do provide really essential services to the economy, and that's going to lead us to understanding fractional reserve banking. And I'm going to go through some parts of this chapter a little bit quickly, some parts a little bit more slowly, because really I see this chapter's main goal as prepping us for chapter 15, where we look at bank regulations and monetary policy, looking at how the central bank in the United States, that's the Federal Reserve, how they manage money supply as a tool to try and manage the economy and control inflation while also keeping an eye on unemployment. So that's what we're doing here. We're going to dive into this chapter, and that's it. Let's get after it. I'm going to go pull up the slides. All right, so let's get started on chapter 14, money and banking. And so here's a little review of everything we're doing if you're following along in class. And over here, this is something I borrowed from a video, but it's a nice way of looking at kind of how we can measure the money supply. We are not going to use all these different measures, but you can kind of see how, we'll talk about this more, how money becomes less and less liquid. So the most liquid thing is going to be, of course, an actual dollar bill, cash, something you can use right away. But as we get further and further away from cash into things that still have value, that's going to be less liquid. And we can talk about that more when we get to that. But this is just a little preview of that. And for context, what we're doing is we're going to be, like I said, going through and talking about how to define money by its functions, how to measure money, looking at currency or M0 and then M1 and M2. And those definitions are going to feed directly into our understanding of how banks create money. But first, we're going to talk about the role of banks. So let's get into that. And so what we have here, just as a little preview, is we do have this little cowrie shell picture here. And this comes from the textbook. And there's a little blurb in the textbook talking about this idea that money has not always been coins and currency. We've always used money, by the definition we're going to use in this textbook. It's just been things like cowrie shells, maybe, precious metals and stones and those kinds of things. And so that's what we're going to be talking about. So getting into it immediately, we define money by its function. And the idea here is that money prevents us from having to barter. Barter is when you just trade something for something else, right? If I trade you some squash for some tomatoes, that's bartering. If I say, hey, will you come cut my hair and I will tutor you in math, that would be barter. It's trading goods and services for each other without exchanging money. And it's all fine and well, but it's not very convenient. Because for bartering to work, we have to have what's called a double coincidence of wants. You have to want what I have at the same time that I want what you have, and we have to be willing to have that exchange. And while that does happen sometimes, it doesn't happen that often. And so maybe you are happy to cut my hair, but you don't need math tutoring. You need a pizza. Well, if I give you money for the haircut, then you can turn around and use that money to buy whatever you want, whether I have it or not. And so with just straight bartering, exchanging, we have to want what the other person has. We have to have that double coincidence, the coincidence of I want what you have, you want what I have. And that's a little bit less efficient, a little bit more complicated. When we look at how we define money by its functions. And these are kind of hard to understand, I think. They can be a little bit esoteric. They can be a little bit not clear. Feels like there's a lot of overlap, so we'll try to make this very transparent. The big idea here is that money is a medium of exchange, right? I can give you money for things and you'll accept it. You can give me money for things and I'll accept it. So it's a widely accepted method of payment. So that's the first thing. It's a way we exchange, a medium of exchange for goods and services rather than bartering. The next thing money does is it is a store of value. It's a way to preserve value over time. And I actually have, I think, a pretty funny clip about this that I'll show y'all if we have time, maybe in a separate video. I think it's a really useful little fun clip taken from a show. But the idea here is that if someone gives me a $1 bill and I hold on to it, it's not going to evaporate. It's not going to go bad. It's going to hold on to its value over time so that I don't have to spend it immediately. If we were talking about a barter where I'm trading you squash for tomatoes, those aren't going to hold value for very long, right? They are, produce goes bad. And so the value declines over time. And we could talk about like, oh, well, there's inflation and we see the value of money change over time. And that's true to a certain extent, but it is possible for that money to hold value. And that gets more into why we pay people interest when we borrow money from them, because we want to account for that value that they're losing. And so the big idea here is, as a store of value, it's not going to go away. The value won't dissipate, get smaller over time or change over time. Money also is going to have to serve as a unit of account. So it's a way for us to compare and measure values across space and time. With unit of account, we're really talking about space. And so this is the idea of comparing apples and oranges. If I want to, I can compare the value of an apple to the value of an orange through money. I can say, oh, well, this apple cost $1.69 a pound. This orange cost $2 a pound. I can make that comparison. I can compare when my friends call me from abroad and tell me how much they spent on something. I can compare it to how much I spent, or even my friends down the street. How much is a gallon of gas in your town? This is how much it costs in my town. We can keep track of value across space with a unit of account. Right? So I can compare my wages, my cost of living here to somewhere else. And that's a really useful function of money. It's also a standard of deferred payment, and that just means money is going to be acceptable for purchases today and in the future. So this idea that we can borrow, that we can pay over time, that money is a unit of account over time. So I can compare how much money I make today to a year ago, those kinds of things. And so money is serving a purpose, not just for exchange, but also in holding value and making comparisons and making purchases across time and space. And so that was really important. And we would consider things that do that money. And so when we think about like a cowrie shell, right, it's a sturdy object. It's going to hold on to value. It's relatively rare, but relatively durable. And then it was accepted for exchange and in payment for different goods and services. And people could compare, well, this item costs 10 shells, this item costs 20 shells, and I'll give you 20 shells tomorrow if you give me something today. All of those are those functions of money being met by, in a historic society, cowrie shells or any other service or any other historic money. Does that make sense? So that's the big idea. We define money by its functions, by this idea that we can exchange for it, we can use it to store value, and we can use it to measure value and payments across time and space. And with a store of value, we're going to want it to be anything that doesn't go bad. So historically, stores of value have been currency, of course, right? Any of the currencies of the world we consider a store of value, but also historically precious metals, silver and gold and even copper. Even when we didn't have centralized banking, coins made of precious metals and even bars and jewelry made of precious metal are considered a store of value. We can think about gemstones the same way. And we can also think about less liquid things like properties, maybe some kinds of cars, maybe art, watches or other kinds of jewelry. Some people consider wine to be very valuable, right? So those are things that, again, are going to either be maintainable in value, grow in value, but not like go bad necessarily if they're cared for properly. And so we can consider them to hold value over time. The other way we want to break money down is into commodity versus fiat money. Commodity money is kind of easier to understand because commodity money is anything that is both money and a thing. So when we think about using, the really common example is when incarcerated people use cigarettes, or now in the more modern era, ramen noodles and seasoning packets as money. They're using it for exchange, but it also has intrinsic value, right? As opposed to, and we can think about gold coins and silver coins. Those are precious metals that have value and have been used as money. Fiat money is different because fiat money does not have intrinsic value. It is declared valuable by the government, right? It has on here, this note is legal tender for all debts, public and private, but its value is given to, inferred by the government, by our belief in that government. And so if I were to take this to another planet and say, hey, look, I've got $1 here, they'd say that's a piece of paper, you're a crazy person. So the difference between fiat money and commodity money is that commodity money does have value in and of itself. If I had gold coins, I could melt them down and do something with them. If I have $1, I can set it on fire. That's about it. US dollars did used to be commodity-backed currencies, right? They had gold in reserves that would be representative of the value of the US dollar. There are lots of pros and cons of commodity-backed money. One of the big cons, and the reason we left the gold standard, was in part because that meant that the value of the commodity could alter the value of your currency, which is pretty problematic. Some people think that gold is the way to go. It's a personal choice. You could research that elsewhere. But generally, in a lot of countries, will tend to use fiat money because it gives you a lot more flexibility with that monetary policy we're going to talk about. And it also gives you a lot more independence and control of your own economy. So fiat money is just money that does not have its own value in and of itself. Its value is based on our belief in our government or based on government decree. Make sense? Hopefully. So we've defined money by its functions. We've defined it by whether or not it has intrinsic value, whether it's fiat or commodity money. And now we want to measure money and define money by its liquidity. And so when we are talking about liquidity, this is a way that the Federal Reserve, the Central Bank of the United States, measures money. And what we do with this is we're just trying to measure how much money is moving through society. And we'll talk about this a little bit more because this becomes important for understanding our economic growth, our productivity, things like our inflation and interest rates and those kinds of really important dimensions of our macroeconomy. And so the Federal Reserve will track our money supply, but they're going to break it down in terms of liquidity. So we talked about this a little bit already. We'll talk about it a little bit more, but the Federal Reserve is the central bank of the United States. They control monetary policy. They issue and clear currency. They clear checks. They regulate banks. They act as a lender of last resort or a backup bank to private banking industry, the private banking industry, and they are the ones who define money. And so M1 is the first level of money definition. M1 is the most narrow definition, and it includes all currency like this, but it also includes money in your checking account. M1 has changed. It now also includes savings accounts, and traveler's checks are included in M1. Traveler's checks used to be a really big deal. It used to be a way for people you would buy traveler's checks from your bank, and they would sort of be accepted as a form of currency abroad. They've really become a lot less meaningful over time. We don't see a lot of traveler's checks. It's still in textbooks. It's just that anachronism, that old thing of, hey, we used to talk about traveler's checks and we haven't gotten rid of them yet. I have not seen a traveler's check since probably the 90s, but that's M1. M1 is the most narrow definition, and it's going to be the easiest access cash. Basically, if I could turn it into cash today, then that's M1. And that's how we can think about liquidity, is how easy is it for me to take this and make a purchase? And $1 is very liquid. But some of these stores of value, this is not a fancy watch, but if you imagine this, if I told you, oh, well, this is a $1,000 watch, if I needed to go buy a tank of gas, I can't just go and give this to the gas station attendant, right? I'd have to go find a seller and exchange it for money and then go buy the gas. And that's a longer process than just giving them cash money. And so that's what liquidity is how easy can I make a purchase with this? And cash and checking deposits and traveler's checks are immediately accessible for purchases. So that's why they're considered M1. M2 contains everything in M1 and also certificates of deposits and small money market funds. And the textbook goes into a lot more detail with this. It can get a little confusing, but the big idea here is that M2 includes everything in M1 and also deposits that take a little bit longer to access. So a money market fund you could pull cash out of, but it's going to take some time. A certificate of deposit, that's usually when you put money into a bank account and you promise to let the bank hold it for longer in exchange for a higher interest rate. So you could pull it out if you wanted to, but you either have to wait for the end of the term, maybe a year, maybe 90 days, 9 months, maybe a couple of years, maybe a decade, or pay a fee. And so that's less liquid than just pulling money out of your checking account with your debit card. I like this graph because I feel like this does a good job of showing us what the difference is between M1 and M2. These numbers down here, the 1.3 trillion and the 7.5 almost billion in M1 and M2 are older. Let's pull up. We can go to the Federal Reserve and it's linked here. We can go and check out what the Federal Reserve says their current So here is the most current that I can access when I'm making this recording, data on money stock. So we can see here, this is from the Board of Governors of the Federal Reserve, talking about, from St. Louis, talking about their release in 2025 of M1 and M2. So you can see M1 here, this is from February of 2024, and then they get more modern down here. And M2 is going to contain M1. We can see that here we talk about M1 being the monetary base. So it's going to contain the monetary base. So that's currency in circulation, reserves in banks, and that's going to add up to give us the monetary base. And that is a component of M1, and then M1 is a component of M2. And so we can see, so this is all measured in, I believe, billions of dollars. So right now in circulation as of June 2020, in June of 2025, there were about 2.39 trillion dollars in circulation, dollar bills, and $3.36 trillion in reserves being held, giving us a monetary base of a little bit over $5.7 trillion. M1 would have been 18.7 trillion and M2 21.9 trillion. So that's kind of cool to see those actual numbers. We can see how they change. We're going to expect money to be more in demand, have more money in circulation as the economy grows, especially as prices go up, just because it's going to cost more to buy stuff, right? If it takes me $1 to go to the movies, then I'm going to have $1 in my pocket. On the other hand, if it takes me $20 to go to the movies, then I'm going to demand more money, and that's going to mean more money in circulation, probably going to be paid more, have higher expenses. Those kinds of things are going to affect M1 and M2. Cool? So that's M1 and M2. Those are our ways to measure the money supply. And so here you get a little bit more detail into M1. It's going to be current coins and currency in circulation, and then what are called demand deposits or checkable deposits. So anything you can withdraw from your checking account day of, and then traveler's checks. M2 is going to include savings deposits, everything in M1, your money market fund, and security deposits or certificates of deposits, what are called CDs, and other time deposits. So now we've got a little bit better sense of how money works, what the functions of money are, what the definitions of money are, and different ways to measure money. And like I said, it's really important to remember that M2 contains M1. We could also talk about there is such a thing as M3. There's such a thing as M0, not referenced here, but the idea is as we go up in number, we're including more things in our money supply. And you see here now that the modern M1, it's a little confusing. The modern M1 includes savings deposits because they are checkable and they are on demand and they are honestly less likely to actually have an interest rate. And so that is a change. There was also a big change in 2020 with, we saw, let me pull it up for you actually. Give me 1 second here. Here you can see, this is from the Federal Reserve, and this is their measure of M1, this big change in M1 that happens in March of 2020. We go from about $4 trillion to $16 trillion. And there's a little footnote here because at that point, they start to change some of the definitions of M1, starting to include those savings accounts and other things. And so that's a big change in M1, and you can see that big one. So it's not that there was something huge that happened in the economy, although there was something huge that happened in the economy in that period. But even if I zoom in here and show you like the small view, it's in a 1 month jump, and it's actually at the end of the COVID-19 related recession. So just a little note there. Cool. Now that we've got a good sense of M1 and M2, one of the things that we do always wonder is how does modern money fit in? We've been talking about traveler's checks. That's great. Who knows what a traveler's check is? So what about all the other ways we actually use money? Our debit cards, our credit cards, and maybe a smart card or money on your phone. Debit cards and anything that's accessing your checking account is going to count as a checkable deposit or a demand deposit. So if you've got a debit card or if you're using Venmo and it's pulling it from your checking account, those are going to be part of M1. A credit card is technically a short-term loan, and so it's really just the credit card company transferring money from themselves to you, and so that doesn't count as money in the sense. It's still the credit card company's money that they're loaning to you, so that would not figure into your money supply or your personal money. It's just the credit card's money. And then a smart cards, those are going to be things like phone card or maybe a gift card for your cafeteria or campus bookstore or something like that. They might be, it's going to depend on whether it's new money that was transferred from a checking account to that you can use to make purchases or not. And that's how we want to think about this is it something I could use to make a purchase today? Then it's probably M1. If it's not my money, if it's not actual money, if it's promised money, then that's not going to count. So hopefully that helps make it make more sense. If you want some more detail, let me know. I'd be happy to do a little bit more detail on this, or you can always check out the textbook. Also, they go into a little bit more detail there than we have here on the slides. So now we're about halfway through our little itinerary. We want to start talking about the role of banks. And banks are really important for a couple of things. They hold the majority of the money in our economy, and most of that money is only electronic. It only exists in ledgers. So when you go online or in your app and you check your banking account, the cash there is not actual dollar bills you have on hand. Most money is electronic. And if you've ever gotten a very big check, I remember one time I got a really big financial aid check when I was in school, and I went and I tried to pull a lot of the money out. The bank doesn't have that much money on hand. And so the bank does one important job, which is just keep track of and hold the majority of our money. They also give us a system to help the economy exchange goods and services, right, through things like bill payment, and helping us, right, deposit paychecks and then withdraw cash to make purchases and those kinds of things. And then the other really important role for banks, according to economists, is to lower transactions costs. And honestly, we could spend a whole bunch of time talking about this, but in a macro class, we've been talking about how important investing is to the economy, right? You need to borrow money to start a new business, buy a car, buy a house, go to school, get some kind of human capital. All those investments in the future tend to require borrowing. But it's very difficult to find someone to borrow from. So banks do this very important job of connecting borrowers with savers. So if I have extra money that I'm not using right now and I deposit it in the bank will take my money as a saver and lend it to someone who needs to borrow. They do that for me without me meeting those people, and it lowers the cost of finding a lender, finding a borrower, those kinds of things. So the joke I always make is, if you needed to borrow money to go to school, what would be the difference between filling out a FAFSA or applying for loans versus going around and just asking everyone you know if they will lend you enough money? One is much higher cost in terms of searching and those transactions costs of searching and making commitments and making agreements than just doing one centralized borrowing agreement from a central entity. And banks provide that for homeowners, for people buying new vehicles, people starting new businesses, people expanding existing businesses, all kinds of things. And so really, banks function in their most important role for the growth of the economy as a financial intermediary. They are in between the saver and the borrower. And so I don't know who might be borrowing the money I have saved in my account. The bank does. The bank checks them, checks their creditworthiness, reviews a loan application, lends them money, gets some interest, gives me a small cut, and keeps the majority of it. And so really, that's the number one job of banks, is connecting borrowers with lenders so that money does flow through the economy better. They also hold deposits so that they can make those loans. So they also have the role as a depository institution, which is just saying, hey, they're an institution that takes deposits. And so this means, and this is where we're going to get a little complicated, and I'm only going to ask y'all to look at this for the sake of understanding the big takeaway here, which is fractional reserve banking. So a bank will have a balance sheet, and a balance sheet just keeps track of their assets and their liabilities. Their assets are things they have and things people owe them. Their liabilities are things they owe to other people. So an asset is something of value that a person owns or is owed, and a liability is a debt that is owed to someone else. And net worth is just assets minus liabilities. And a bank's net worth is also called a bank's capital. We're going to do an example, and then we'll walk away from this. The big idea here is to understand how banks lend money that is deposited, their role as a financial intermediary and a depository institution, along with what we're going to talk about in a minute, fractional reserve banking, allows for money creation and monetary policy. So we're learning about bank balance sheets for a reason, I promise. So banks tend to track their balances with what's known as a T account. It's called a T account because, oh my gosh, look, it's a line and a line. That's like a giant T. So it helps us track all the bank's assets and all the bank's liabilities. So we put assets on one side, liabilities on the other. So here we see this bank has $5 million in loans. That means they have issued loans to people in the amount of total $5 million. So that's money that people are paying them back. They also have $4 million in government securities. So that means those are assets. Those are debt instruments. The government owes them money and is paying interest on it. That's a way for banks to limit their risk. They also have reserves. That's cash that the bank is holding on to and not loaning out. But we can see it's much smaller than the quantity of loans they're issuing. In terms of liabilities, their big liability here is $10 million in deposits. And you might be thinking, how are deposits a liability? That's the money that's in the bank. Yes, but it's not the bank's money, it's our money. If I deposit my money in the bank, they can hold it in reserve or give it out as loans or use it to buy government securities, but it's still my money that I may ask for down the road. So it's a liability because the bank owes it back to the saver. Does that kind of make sense? So if we add these up, the government has $5 million in loans, $4 million in securities, and $2 million in reserves. 5 plus 4 plus 2 is 11. Their deposits are 10 million. So that means that if they paid back every single person all the money that was held in the bank, they would have $1 million left. Does that make sense? We use this to help us understand money creation. And so we'll get to why this is important. So who's in charge of banks? Banks are in charge of our money. Who's in charge of them? The answer to that is your central bank. Central banks are institutions that oversee the banking system and regulate the money supply in any given country. In the United States, our central bank is the Federal Reserve, also called the Fed, and they institute and enact monetary policy, which is basically just using the money supply to try to enact change in the economy. So you set the money supply as policymakers in this central banking institution to try and manage inflation, manage a recession, all those kinds of things. So our Federal Reserve in the United States is composed of 12 regional banks, a board of governors. There's a Federal Reserve chair. Our current Federal Reserve chair is Jerome Powell. Prior to him, it was Janet Levin, then Ben Bernanke, and then Alan Greenspan, going back further and further. There's lots of history to the Federal Reserve, and the whole point of the Federal Reserve is that it is supposed to be independent of the government so that they can make their own decisions. So if they are independent of the government, how does the Fed control monetary policy? Well, the Fed controls monetary policy by dictating some of the bank's decisions. And this gets back to this fractional reserve banking system that I've been talking about since the beginning of this video. Fractional reserve banking is just what it says. It's a banking system where a fraction of deposits are kept in reserve. And so just like I said back here when we talked about these T charts, if I make a deposit of, say, $3 million and the bank keeps $2 million and loans out $1 million, well, then that's a fraction of what I've deposited has been kept in reserve. And that ends up being the key to understanding how monetary policy works. And so reserves are money that a bank keeps on hand and does not loan out or use to buy bonds or securities or some other kind of debt instrument. The Federal Reserve, as the regulator of banks, sets a minimum reserve requirement. And a financially healthy bank is going to have some reserves, either in cash or in bonds, to protect itself from potential loss, people not paying their loans back. Think the Great Recession. So a bank may have, if a bank has a negative net worth and depositors try to withdraw their money, then they might not be able to pay back all of their liabilities. And that would be bad. That's when banks go bankrupt. It's when they don't have enough money to give back to their depositors. And so there's lots of different ways we could dive into that. We've seen bank failures in the modern era. We've seen a lot of historic bank failures in general. Usually a string of bank failures will lead to a string of regulation. If you're interested in this, a money and banking class will really give you a cool sense of how all this works. We're going to talk about the very, very basic bare bones of this stuff, just enough to help us understand monetary policy, but it's really cool stuff. And so one of the big ways that we see the government and the Federal Reserve regulate banks is try to keep them from over loaning, over leveraging, not having enough assets relative to their liabilities. And another way that they can do that is with diversity. So having lots of different kinds of assets so that if one asset fails or loses value, they've got protection. So I'm not just giving out lots of loans. I also have government bonds. I also have cash reserves. Maybe I have different kinds of bonds and securities to help me save and protect myself. That's the big idea. So banks want to make money. Not a surprise here. The easiest way for a bank to make money is to issue a loan. So I'm going to go through this example and I'm going to show you another example on the board, a simple example. But the idea here is that because we count M2 as including currency and checking accounts and savings accounts and all these other different accounts, and banks only keep a fraction of reserves in cash, we can actually see banks create money without literally printing more bills, but instead by making loans and keeping a fraction of each deposit in reserve. So we start out with a single bank here, and someone has deposited $10 million in the bank. And so immediately the bank gets $10 million in reserves and owes that money to someone else. So in this T account, they're just storing the money for depositors, not making any loans. And it can't pay interest or earn interest because it's just holding money. So instead it says, hey, I got an idea. Rather than just holding on to all this money, what if I loan some of it out? Not all of it. That would be crazy. I'll loan out 90% of it. I'll hold 10% in reserves. 10% of 10 million is $1 million, and $9 million will be loaned out to Hank's Auto Supply. We still have, right? We still have 1 million in reserves and 9 million in loans. We still owe that money back to the person who deposited it. But now what's going to happen is we're going to see that $9 million loan be deposited in another bank. And now that bank has $9 million in liabilities and $9 million in reserves. We have just grown that first $10 million into $19 million because there's still the $10 million being held at the first bank at Singleton Bank. But now there's also this $9 million loan that Hank's Auto Supply has to pay back being held in First National. First National is going to say the same exact thing. I'm not holding all this money here, earning no interest, paying no interest. I can also loan it out. I can't loan out all of it. I can loan out 90% and keep 10% as reserves. So they go ahead, they make a 10% loan, a 10% loan out of they keep 10% as reserves, make a 90% loan. So 10% of 9 million is 900,000. So they make a loan of 8.1 million. And then that 8.1 million is deposited into another bank. And now we have created more money. So fractional reserve banking creates money. I think this is one of the more confusing and complicated parts of this. So I'm going to come and give you a super basic, simple example on the board. Okay? Let's imagine I've got my $20 here, right? And so I'm going to start out with $20 cash. And if we were going to measure this in that sense where we've got M1 and M2, well, $20 is just $20, right? That is going to be M1 equal to $20. Now, let's put it in a fractional reserve banking system where we've got assets and liabilities. in my little T-chart here. And I'm going to try to make this fun and cool. And I'm going to use all my colors because I think that colors help make it clear. But we'll see if it helps or if it makes it crazy. So now let's say instead of holding my $20 in cash and dropping all of my pens on the ground, I'm going to deposit it in the bank. Now the bank owes me my $20 and it has my $20. But we know banks don't like to hold on to money. They like to make loans. So let's imagine now, instead of having a percentage of reserves, let's just say we're going to have them, banks hold $1 in reserve. This is not realistic, but it's a great example to kind of get how this works. So that means that they can then go out and make a $19 loan. Now let's put it in here, right? So now they've got that $20 is going to turn into a $1 reserve and a loan for $19. They still owe me my deposit of $20, but now someone's got those $19 in their pocket. If they go through and put that in another account, now that money is going to show up in someone else's account as a new deposit of $19. And now that they have made that $19 loan, M1 and M2 are going to have my $20 deposit and this person's $19 deposit. So that's going to be, the money supply is now going to be $39. You see that? We're making money. Then we're going to still hold $1 in reserve. So this bank is going to hold $1 in reserve now, which means they can make a loan for $18. And that $18 can be deposited into another bank, any bank. It becomes a new deposit of $18. Now the money supply has grown again. It's going to have $20 plus $19 plus $18. That's going to give us, what, $57? And we could see how that would keep going, right? Now they hold $1 in reserve. Let's add another color here. Oh, I'm supposed to stay with the pink. I forgot my color scheme already. They're going to reserve $1, loan out the remaining $17, and that can then be deposited into another bank. And that's going to add another $17 to the money supply. Now our money supply is going to include 20 plus 19 plus 18 plus 17. That's going to give us, what, $74, and so on. And it'll keep going like that until the banks decide not to give out loans anymore. And it works. This is how banks work all around the US all the time. And almost every time it's fine. Sometimes it's not. Sometimes we have what's called a run on a bank. That's not great. That would be if I came in and I said, hey, I want my $20 back. And they said, ooh, well, I only have one. Can you come back tomorrow? And then I told my friends, hey, my bank doesn't have my money. And they all came in and said, we want our money too. That would be bad. That's when fractional reserve banking fails. But usually banks have more than just $1 in reserve, and they can make people whole. They can liquidate assets. They can do stuff like that. And usually people don't want to pull their money out of the bank. They like knowing their money is in the bank. And so this is fractional reserve banking. You keep a fraction of every deposit in reserve, and then you loan out the remainder, and it multiplies the money through the economy. And this is a huge role banks play, and it's really important to understanding monetary policy. So that's how fractional reserve banking works. And that gives us this way that cash deposited into the banks can multiply through the economy with fractional reserve banking. And so every dollar deposited in the bank multiplies through the economy through these multiple banks. And so we actually call this the money multiplier. And the idea is that the smaller the reserve requirement, the more money is going to grow through this fractional reserve system. We actually have what's called the money multiplier formula, which says, hey, whatever the reserve requirement is, 1 over it is going to be how much money multiplies through the system. So for example, if we've got, this example's in the textbook, so you can go in and take a look at it, but if we have a reserve requirement of 10%, we use that a lot in examples because it's a nice, easy number. But if we've got a 10% reserve requirement and a bank has reserves of, or has $9 million in cash, what's the money supply? Well, what we do is we just take 1 divided by 0.1 and multiply that by our 9 million to get $90 million of the total money supply created by fractional reserve banking in this system. The money multiplier is really useful because it helps us understand how we can grow or shrink the economy through fractional reserve banking. And this becomes really important when we want to try to grow and shrink the economy using money supply. The quantity of money in an economy is really closely linked to how much lending and credit is happening. And when we see that money be redeposited and reloaned out, it can really power up an economy by creating the possibility for people to grow the economy with loans, with new economic activity, and getting more money out there. Banks can, so the Federal Reserve sets a required reserve ratio, a percentage that banks have to keep of every deposit. Banks can choose to keep more. It's kind of like how you might have I was going to say speed limit as an example. That's not a great example. But the idea is the Federal Reserve sets the minimum requirement for reserves. The banks can go above it if they want to. A great example of this was during the Great Recession in 2008 and 2009. A lot of banks saw massive defaults in loans. And so they kept a lot of additional reserves because they were worried about more defaults in mortgages, regardless of what the Federal Reserve's reserve requirement was. There might also be government regulations trying to limit bank risk, and that can also affect reserves. In recession, we see banks hold higher reserves because they're worried about the future and they don't want to become insolvent. They don't want to fail. The Federal Reserve can also lower and raise the requirement as part of their monetary policy, which is why we're learning about this. The other thing is, if people are, if you're keeping all your money buried in a mason jar in your backyard, then that money can't multiply through the economy. It's like my $20 bills, right? It's just my $20 bill. If I don't put it in the bank, it's just what it is. It's only through entering it into the banking system that it's allowed to multiply through. So that's everything that I feel like you need to know from this chapter to be able to understand monetary policy. And that's where we're going next. We're going to look at our model of aggregate demand and aggregate supply. And then we're going to talk about how monetary policy and fiscal policy can alter that market. We've talked already, hopefully, about, you're aware, we've already talked about fiscal policy. Now we can talk about monetary policy. And there are going to be 3 traditional tools of monetary policy used by the central bank to control inflation. So that's it. That is chapter 14, money and banking. Hopefully you've got a better understanding now of how banks create money, what the role of fractional reserve banking is, and how we can use it and leverage fractional reserve banking to really have a better understanding of growing the economy and manipulating the money supply. So let me know what questions you have, and I'll see you next time.